Hey everyone, welcome back to Gold Rush Reporter, your trusted source for real, unfiltered analysis on silver, gold, and the global metals market. I'm your silver analyst, here to break down what's really happening behind the charts. Because what's coming over the next 24 to 48 hours could shake things up fast. Let's get straight into it. Gold and silver have both been on an absolute tear lately, hitting levels we haven't seen in over a decade. Silver just touched 42.96, marking a new 14-year high, while gold has crossed a record-breaking $3,703 per ounce, the highest in recorded history. These are massive moves, but whenever you see explosive rallies like this, one thing always follows: volatility. And right now, it looks like a short-term correction or even a sharp sell-off could be on the horizon. Now, before you panic, this isn't bad news. Not if you understand how to position yourself correctly. In fact, opportunities often appear right when others start to fear the drop. And that's what today's breakdown is all about. How you can protect your position or even benefit from what's coming next. Here's the setup. The metals market, especially silver, has been climbing rapidly for weeks. Traders have been pricing in a potential rate cut from the Federal Reserve, which will be announced tomorrow. The Fed's decision could create a chain reaction across gold, silver, and mining stocks. According to the CME FedWatch tool, there's a 96% chance we get a 25 basis point rate cut, and only a 3.9% chance of a 50 basis point cut. Now, if the Fed surprises with a 50-point cut, we could actually see prices hold or rise even higher. But let's be honest, that's highly unlikely. The far more probable outcome is the smaller expected cut. And here's where the trap comes in. The markets have already priced that in. When traders say, buy the rumor, sell the fact, this is exactly what they mean. Prices rise in anticipation of a decision, then dip right after it's confirmed. That's what we're facing now. Silver and gold have been running hot because everyone's expecting easier monetary policy. Once that decision becomes official, don't be surprised if the market corrects. Not because anything's wrong, but simply because traders take profits after a long run-up. Look at the technicals. The Relative Strength Index, RSI for silver, has been sitting above 70. That's the warning zone. When an RSI pushes past 70, it's a clear signal that the asset is becoming overbought, meaning it's too hot and due for a cool down. Gold's RSI is even higher, around 78, and some of the miners, like SELJ and GDX, have been flashing readings of 80 or more. So in plain terms, the market's overextended. A short-term dip would be completely normal. It doesn't signal the end of the bull market. It's just a breather. A moment for prices to reset before the next leg up. We'll dive deeper into how to play this correction smartly in the next part. And trust me, if you're holding physical silver or thinking about increasing your stack, this upcoming window could be the perfect setup. As we move into this part of the analysis, let's focus on the bigger picture. What's actually driving this potential short-term sell-off and how it connects to the Fed's next move. Tomorrow's announcement is crucial. The Federal Reserve's rate decision is not just about interest rates. It's about how the entire global market reacts to changing liquidity. And for assets like gold and silver, liquidity is everything. Now here's the reality. The precious metals market has been feeding off expectations of lower interest rates. When the Fed cuts rates, it weakens the dollar and increases the appeal of real assets like gold and silver. But the market isn't naive. It anticipates these moves ahead of time. That's why we've seen gold and silver shoot up so aggressively since Jerome Powell's Jackson Hole speech, where he hinted at easing monetary policy starting in September. So what's happening right now is the front run. Traders have already positioned themselves for the cut. They've bought the rumor. Once the official announcement drops, many will lock in profits, leading to what we call the sell the news effect. This is standard market psychology, and it's why you shouldn't panic if prices drop. Corrections like this are part of the game. If we look at the charts, silver's RSI above 70 and gold's pushing near 78, both classic signs of short-term overheating. The CLJ ETF, which tracks junior silver miners, has been running with an RSI above 80, which is unsustainable in the short term. Even the GDX, which represents larger gold miners, has started to cool off, already showing signs of a mini pullback. So yes, a correction seems likely. But here's the critical part. It's not the end of the bull run. It's just a reset before the next surge. The fundamentals for silver and gold remain extremely bullish. Inflation remains high, the M2 money supply is still expanding, and central banks around the world are stockpiling gold like never before. The conditions for a continued bull market are stronger than ever. If we do see a dip following the Fed announcement, expect it to be short-lived. Smart money, big investors, sovereign funds, and high net worth individuals will likely use that drop as a buying opportunity because they know exactly what's coming next. More liquidity, weaker dollar, and stronger metals. For everyday investors, the best move might be to prepare rather than react. Don't chase green candles. Wait for red days. When others sell in panic, that's your moment to build or strengthen your position. If you believe in the long-term fundamentals of gold and silver, a small dip shouldn't scare you. It should excite you. We're entering a phase where monetary easing, asset inflation, and fiscal instability are aligning perfectly for precious metals. The upcoming correction, if it happens, could be the last cheap buying window before a much larger breakout. All right, let's get straight into the strategy side of things. If we really do see a short-term pullback in gold and silver, this is where real investors separate themselves from emotional traders. A correction is not a signal to run. It's a signal to position smarter. The question is, how do you do that without overexposing yourself or panicking when prices dip? First, let's look at what's actually happening in the market. The mining sector has been running incredibly hot for months. The GDX, which tracks gold miners, is still up significantly year to date, and the SILJ, which tracks junior silver miners, has surged over 100% in the same period. That kind of run-up can't go on without pauses. When you combine high RSI readings with rate announcements and speculative positioning, the setup for a short-term drop becomes almost inevitable. But here's the key. Even if we get that drop, it's unlikely to last long. Why? Because the underlying fundamentals are still screaming bullish. The Fed is cutting rates while inflation remains stubbornly high. That's like pouring gasoline on a fire. More money, cheaper credit, weaker dollar, higher asset prices. Precious metals thrive in exactly this kind of environment. So, what can you do to turn this to your advantage? The first thing, and probably the smartest, is to use any dip as a buying opportunity in physical silver or gold. Not financial advice, but historically, corrections during bull markets are where wealth is built. Instead of chasing tops, disciplined investors accumulate during pullbacks. Second, if you're into paper assets like mining stocks or ETFs, be selective. Look for strong balance sheets, companies with low debt, and high cash flow from operations. These miners will outperform when the next leg of the bull market begins. Weak companies might not survive if volatility increases. Now, for traders who understand derivatives, there's another angle. Some may use short-term put options to hedge against sudden drops. This approach allows you to protect gains without selling your core holdings. But be very clear, options are risky. If you don't know what you're doing, you can lose money fast. They're tools for managing exposure, not gambling tickets. Personally, I'd rather keep my core position in physical bullion and add during weakness. Physical metal doesn't rely on digital markets or counterparty risk. When you hold real silver or gold, you're not just investing. You're preserving purchasing power in a world that's printing money non-stop. The upcoming dip, if it happens, should be treated as a gift, not a threat. These short-term fluctuations are simply the cost of participating in long-term wealth cycles. The big mistake most investors make is chasing rallies and panicking during pullbacks. The professionals do the opposite. If you zoom out and look at how previous bull markets have unfolded, every single one has had corrections like this. Brief, sharp, but followed by massive surges to new highs. That's the pattern. That's the rhythm of a metals bull run. Let's talk about the technical setup, the part where price action tells us what's really happening beneath the surface. Right now, both gold and silver are showing classic signs of being overextended on the daily charts. The RSI for silver has pushed past 70, and for gold, it's hovering close to 78, both in clear overbought territory. That's not a bearish signal by itself, but it does mean one thing. The market's running too hot and is due for a cool down. If you look at the SILJ, Junior Silver Miner ETF, its RSI even touched 80 recently. That's extreme. The GDX, Gold Miner ETF, also crossed 70, even though prices are already pulling back slightly. In technical terms, we call this a momentum exhaustion. It doesn't break the trend, it just gives the market room to breathe before the next push higher. Now here's something I want you to understand. During a bull market, pullbacks like these are not the end. They're the reset points. Every major breakout in the metals sector, whether in 2011, 2020, or even the smaller 2016 run, followed the same pattern. A huge surge, a steep correction, then a violent rally that made the previous highs look cheap. That's how strong uptrends build, on the backs of shaken out weak hands. Take a look at the GDX chart. You'll notice a green resistance line marking the highs from the 2011 bull market. We've finally broken above that level, and now we're likely to retest it. That's a textbook move. What was once resistance becomes support. If the GDX bounces cleanly off that zone, it confirms that this breakout is real, not a fake out. The same thing's happening with SILJ. It's just broken out of a long-term consolidation channel, and technically, it makes perfect sense for it to pull back, test the breakout line, and then resume its uptrend. The charts are telling us this is a healthy market cycle, not a collapse. Here's the mindset difference between professionals and retail traders. Pros expect corrections, plan for them, and use them to accumulate more. Retail traders panic, sell low, and watch from the sidelines as prices recover. If you understand that structure, breakout, retest, continuation, you'll stop seeing dips as threats and start seeing them as opportunities. So, what should you watch for in the next 48 to 72 hours? If gold holds above $3,600 and silver stays near the $40-$41 range without breaking down sharply, that's strength. A brief dip below those levels is fine as long as buyers quickly step back in. That's your confirmation that institutional demand is still alive. But if both metals bounce hard after the Fed announcement, that could trigger a short covering rally. And trust me, that kind of move can be explosive. We've seen silver jump 10-15% in a single session after Fed policy shifts before. The market's setting up for another big leg, and this correction, if we even get one, will likely mark the start of it. The key is patience. Don't chase, don't panic, and definitely don't underestimate how fast things can turn when confidence swings back into precious metals. All right, let's bring this home. Here's the truth. Short-term volatility is part of the game. What really matters isn't the dip that might come tomorrow, but how you react to it. Whether it's a Fed announcement, profit-taking from miners, or algorithmic selling, it doesn't change the long-term structure of this bull market. The fundamentals behind gold and silver are solid. Inflation isn't gone, currencies are still being devalued, and central banks are buying metals faster than they have in decades. That's why, even if we see a sell-off in the next 24 to 48 hours, I see it as an opportunity, not a threat. These are the moments smart investors prepare for. The ones who understand this market don't chase highs. They accumulate during weakness and hold their conviction when everyone else is nervous. If you've been stacking silver for a while, you already know. Every major correction has led to a stronger recovery. It happened in 2008, it happened again in 2020, and it's happening now. The trick is not to overthink short-term noise. The Fed might cut 25 basis points or 50. Either way, they're loosening policy again, and that's bullish for metals. The buy the rumor, sell the news dynamic can shake prices temporarily, but the underlying trend doesn't break. Once the dust settles, liquidity floods back into commodities, and metals lead the next wave. When that happens, you'll see silver outperform almost everything else. So, if prices dip, keep calm. Don't get caught in panic selling. Look for opportunities to add to physical positions, maybe scale in slowly if the pullback extends. Remember, markets reward patience, not emotion. And here's something else. Even if tomorrow brings a red day, that's part of the process. Every bull market climbs a wall of fear. And this one's no different. So, stay alert, stay informed, and stay disciplined. That's it for today's analysis. If you found this breakdown useful, make sure to like this video, share it with other silver investors, and subscribe so you don't miss my next update. This is Gold Rush Reporter, your trusted source for sharp and honest silver analysis. I'll see you in the next one. Stay strong, stay prepared, and as always, keep stacking.